Every fortune leaves clues. Every billion-dollar empire follows a blueprint. We dissect the strategies behind wealth creation, business building, smart investing, and technological innovation. Welcome to the Wealth Blueprint, the strategies behind wealth and innovation.
The AI Arbitrage Playbook. In 2019, a former truck driver in Ohio named Marcus Chen had $847 in his checking account and $40,000 in credit card debt. By 2024, he owned 3 companies generating $2.3 million annually. He never learned to code. He never raised venture capital. He never even incorporated his first business until month 11. What he did was simpler. He recognized a gap, a temporal advantage, a moment when the tools became powerful enough to replace entire departments, but the people who controlled the money still did not understand what the tools could do. This is not a story about artificial intelligence. This is a story about arbitrage, the systematic exploitation of information asymmetry. And right now, the asymmetry is the widest it has ever been in human history. Let me be precise about what we are discussing. The traditional paths to wealth, those are collapsing in real time, not theoretically, actually. The college degree that guaranteed a $75,000 entry-level salary in 2010 now guarantees $52,000 in purchasing power-adjusted terms, with $45,000 in debt. The corporate ladder has been replaced by the corporate treadmill. More hours, less equity, no security. Real estate, once the reliable accumulator of middle-class wealth, now requires capital most people will never possess. But simultaneously, something unprecedented is happening. The cost of executing complex business operations has collapsed toward zero, not reduced, collapsed. What required a team of 20 in 2015 requires one person with the right AI stack in 2025. This is the AI arbitrage, the window between what AI can accomplish and what the market understands AI can accomplish. And windows like this do not stay open indefinitely. Historically, arbitrage windows of this magnitude have lasted 8 to 14 years. The Internet commercialization window, 1995 to 2008. The mobile app window, 2008 to 2016. We are currently 4 years into the AI arbitrage window. The question is not whether you will participate. The question is whether you will recognize the pattern before it closes. To exploit this arbitrage, you must understand its 3 structural forces, not theories, operational realities. First, the labor cost collapse. In 2015, a professional quality marketing campaign required a copywriter at $75,000 per year, a graphic designer at $65,000 per year, a media buyer at $80,000 per year, and a strategist at $120,000 per year. Total annual labor cost, $340,000. Minimum viable team, 4 people. Office space, equipment, benefits, management overhead, additional $100,000 annually. Total, $440,000 to produce marketing campaigns at professional standard. In 2025, the same output, professionally indistinguishable to 98% of consumers, can be produced by one operator using Claude for copy generation at $20 per month, Midjourney for visual assets at $30 per month, and programmatic advertising platforms with AI optimization at variable cost based on spend. The labor cost collapses from $440,000 to approximately $18,000 in subscription fees and the operator's time. This is not automation. This is replacement. The difference matters profoundly. Automation makes existing workers more productive. Replacement eliminates the category of worker entirely. Second, the democratization of knowledge. Previously, industry-specific expertise was hoarded. It lived in the heads of senior practitioners, in proprietary databases, in relationships built over decades. AI has ruptured this hoarding mechanism. Large language models have ingested the collective written output of human civilization, legal precedents from every jurisdiction, medical research from every specialty, financial models from every market condition, engineering specifications for every material and structure. The expertise that once required 10 years of specialized education now requires the ability to ask precise questions. This creates synthetic expertise, the ability to project authority and competence in domains where you have no formal training, because the AI possesses the training, and you possess the operational intelligence to direct it. I want to be careful here. This is not fraud. You are not claiming credentials you do not possess. You are claiming capability that the AI provides, and you are transparent about the method. The value proposition is explicit: AI-enhanced output at reduced cost and increased speed. Third, the regulatory lag. Every technological revolution creates a period of regulatory ambiguity. The laws have not caught up to the capabilities. Existing frameworks were designed for the previous technological regime. They do not address, and often cannot conceive of, the new possibilities. This is not an invitation to criminality. It is a recognition that existing business models, licensing requirements, and professional gatekeeping mechanisms are designed for a pre-AI economy. They assume human labor, human expertise, human delivery. They do not account for AI substitution. The businesses being built in this window will eventually face regulation. Professional associations will lobby for protection. Governments will scramble to tax and control. Liability frameworks will evolve. But the regulatory frameworks will be designed reactively, years after the patterns are established. By then, the arbitrage window will be closed. The winners will have consolidated. The new regulatory environment will protect incumbents who have already scaled, not prevent their emergence. Your opportunity is the gap between technological possibility and regulatory response. This gap is typically 5 to 10 years. We are currently 4 years into the AI revolution. The window is narrowing, but it remains open. Theory is insufficient. You need to see the mechanics in operation. Here are 3 detailed case studies. First, the synthetic agency model. Subject: former customer service representative, age 34, Phoenix, Arizona. Starting capital: $2,400 saved from tax refund and selling personal items. Marcus had worked in call centers for 12 years. He had no marketing experience, no design training, no business education. He had observed, however, that the small businesses he interacted with as a consumer had terrible marketing. Websites from 2008, social media abandoned after 3 posts, advertising that was clearly wasting money. He also noticed that these businesses knew their marketing was bad. They were embarrassed by it. They wanted help but could not afford agency rates. The local marketing agencies charged $5,000 monthly retainers minimum. The businesses he observed were struggling to make $10,000 monthly revenue. The math did not work. The model Marcus developed: a full-service digital marketing agency that employed 0 marketing professionals. He would use AI to generate client proposals, AI to create campaign assets, AI to manage client communication, and a network of freelance contractors, paid per project, to handle any requirements that exceeded AI capabilities. He started with one client, a local auto repair shop. He approached the owner with a simple proposition: I will rebuild your website, create your social media presence, and run your advertising for $1,500 per month. No contract. Cancel anytime. I use AI to keep costs low and deliver agency-quality work. The owner agreed. Marcus had never built a website. He had never run an ad campaign. He had 3 days until the first deliverable was due. He used ChatGPT to write the website copy, focusing on the specific pain points of the auto repair customer: fear of being overcharged, uncertainty about what is actually wrong, inconvenience of being without a vehicle. He used Midjourney to generate hero images and service photos. He used a no-code website builder with AI-assisted design to assemble the site. He used Meta's AI-powered ad tools to create and launch the initial campaign. The website was not award-winning. It was professional. It loaded fast. It answered the questions customers actually had. The ads were not creative masterpieces. They targeted the right people with the right message at the right time. Results after 30 days. The auto repair shop saw a 40% increase in appointment requests. Cost per acquisition dropped from $180 to $67. The owner, delighted, referred Marcus to 3 other business owners. By month 6, Marcus had 12 clients. He was working 80 hours per week. But his revenue was $18,000 monthly. His costs were $400 in AI subscriptions and $2,000 in freelance contractors for overflow work. Net, $15,600 monthly. Critical insight. Marcus never claimed to have marketing expertise. His value proposition was explicit. We use AI to deliver agency-quality output at 40% of traditional agency pricing. This transparency was his differentiator. Clients were not deceived. They were informed participants in the arbitrage. They understood they were buying AI-enhanced service, not traditional agency service, and they preferred the trade-off. By month 12, Marcus incorporated. He hired his first employee, a client manager to handle communication, freeing him to focus on operations and new client acquisition. By month 18, he had 28 clients and 2 full-time employees. Year 1 revenue, $340,000. Year 2, $890,000. The founder sold the agency in year 3 for $1.2 million, having never personally hired a single traditional marketing professional. The buyer was a regional agency seeking AI capabilities. They paid for the client relationships and the operational model, not for talent or proprietary technology. Marcus had built a $1.2 million asset from $2,400 in starting capital and his own operational intelligence. He is not unique. He was simply early and he executed with precision. Second, the AI-assisted arbitrage. Subject, former retail manager, age 41, Tampa, Florida. Starting capital, $15,000 from home equity line of credit. Alina had managed a big box retail store for 15 years. She understood inventory. She understood supply chains. She understood that retail was fundamentally about buying low and selling high, and that the difference between success and failure was information advantage. She left her job in 2022 with a specific observation. The e-commerce arbitrage market was mature, saturated, and competed on speed of manual execution. Thousands of sellers scanned Amazon and Walmart and Target looking for price discrepancies, buying low on one platform and selling high on another. The margins were compressing. The work was exhausting. The winners were those with the fastest fingers and the most stamina. Alina recognized that this was a race to the bottom that humans could not win, but it was also a market that AI could dominate completely. The model, e-commerce arbitrage amplified by AI predictive modeling. She would use AI tools to analyze Amazon pricing data, identify temporary supply disruptions, predict demand spikes, and automatically adjust inventory positions across multiple platforms. She started with $15,000 and 3 specific AI tools, a pricing intelligence platform with machine learning capabilities, a demand forecasting model trained on historical e-commerce data, and an inventory management system with automated reordering. Traditional arbitrageurs relied on intuition and manual monitoring. They would check prices, spot discrepancies, buy inventory, hope it sold before the price changed. Alina relied on algorithmic speed. Her system monitored 50,000 products continuously. It identified opportunities in milliseconds. It executed purchases automatically within parameters she set. The AI did not just spot current discrepancies, it predicted future ones. By analyzing patterns of supply disruption, weather events, port delays, manufacturer production schedules, it could anticipate which products would become scarce and which would see price spikes. Alina bought before the scarcity, not during it. Her role was not product selection. It was capital allocation and risk management. She set the parameters: maximum investment per product, maximum inventory holding period, minimum margin threshold. The AI executed within those parameters. She monitored the system, adjusted the parameters based on performance, and managed the relationships with suppliers and fulfillment services. First month, $3,200 profit. Sixth month, $18,000 profit. 12th month, $67,000 profit. Year 1 revenue, $780,000. Net margin, 34% after all costs including software, fulfillment, and returns. The operation scaled to 7 figures by month 14. Critical insight: Alina did not compete on the same terms as traditional arbitrageurs. She did not work harder. She did not scan more products manually. She built a system that made manual competition impossible. Traditional arbitrageurs could not match her speed, her scale, or her predictive accuracy. By the time competitors understood what she was doing, she had already captured market position and accumulated capital. She could afford to compress margins further if needed, though she preferred to maintain them and accept slower growth. The operation now runs with minimal daily involvement. Alina spends her time on system optimization and exploring new markets. She has not worked more than 20 hours in a week since month 8. This is the arbitrage in action, not working harder, not working smarter in the traditional sense, building systems that make the old way of working obsolete. Third, the content leverage model. Subject: former teacher, age 29, Austin, Texas. Starting capital: $800 from credit card cash advance. David taught high school history for 4 years. He was competent, not exceptional. He observed that his students were not failing because the material was difficult. They were failing because they were unprepared for the standardized tests that determined their futures. He also observed that test preparation was a massive industry. Kaplan, Princeton Review, private tutors charging $200 per hour. The quality of instruction was inconsistent. The cost was prohibitive for many families. The market was ripe for disruption by someone who understood both the educational content and the business opportunity. David had no expertise in test preparation. He had never taken the specific exams his students were struggling with. He did not let this stop him. The model: educational content creation at industrial scale. He would identify high-value, underserved niches in professional certification exams, use AI to generate comprehensive study materials, practice examinations, and personalized tutoring protocols. Monetize through subscription and affiliate partnerships with test prep companies. He started with the real estate licensing exam. This was strategic. High stakes for test takers, high failure rates creating demand for help, fragmented existing providers, and clear financial incentive for test takers to invest in preparation. David used AI to analyze every publicly available real estate exam from the past 10 years. He identified patterns in question types, topic distribution, and common failure points. He used this analysis to create a comprehensive study guide, thousands of practice questions, and a personalized study plan generator. The content was not original in the traditional sense. It was synthesized, organized, and optimized by AI based on existing information. David's contribution was curation, quality control, and understanding the psychology of test takers. He knew what they were afraid of. He knew what would motivate them. He knew how to present the information for maximum retention. He launched with a simple website, a $49 study guide, and targeted Facebook ads. First month, 23 sales, $1,127 revenue. Costs, $200 in AI subscriptions, $300 in advertising. Net, $627. By month 6, he had expanded to 3 additional exams: insurance licensing, nursing certification, and project management. He had built a subscription model, $29 monthly for access to all materials, personalized study plans, and AI-generated practice exams tailored to individual weak areas. Month 6 revenue, $12,000 monthly. Month 12, $28,000 monthly. Month 18, $47,000 monthly. Critical insight: David had no expertise in real estate, insurance, nursing, or project management. The AI generated the expertise. His value was curation, quality control, and understanding the psychology of test takers. He knew how to direct the AI to produce what students actually needed. He knew how to market to their specific anxieties and aspirations. The operation now employs 2 contractors for customer service and content updates. David spends his time on new exam identification, system optimization, and strategic partnerships. The business runs largely autonomously. This is synthetic expertise at scale, not faking knowledge, deploying knowledge without traditional acquisition. The AI knows more about real estate licensing than any single human expert. David knows how to make that knowledge accessible, affordable, and actionable for test takers. The market does not care where the knowledge comes from. It cares about results. David's students pass at rates 15% above average. That is the only credential that matters. You are not building a traditional business. You are building a control system. Your function is not execution. Your function is orchestration. Here is the operational architecture used by the case studies above. Layer 1: Intelligence. Claude or GPT-4 for complex reasoning and content generation. These are your general-purpose cognitive engines. They write, they analyze, they strategize, they code with guidance. Perplexity or specialized research AI for real-time information synthesis. These tools access current information, not just training data. They cite sources. They verify claims. Custom GPTs trained on specific domain knowledge. Once you identify your vertical, you build specialized models that understand your specific context, terminology, and requirements. Layer 2: Production. Midjourney or Stable Diffusion for visual assets. Professional quality images from text descriptions. Logos, marketing materials, product photos, concept art. 11 Labs or similar for voice synthesis. Professional voiceover without studio time. Multiple languages, multiple styles, consistent quality. Runway or Pika for video generation. Animated content, promotional videos, educational materials without production crews. Cursor or similar for code generation. Even if you do not code, you direct coding. Describe what you want built. The AI writes the code. You review, you test, you deploy. Layer 3: Distribution. Programmatic advertising platforms with AI optimization. Meta, Google, and emerging platforms that use machine learning to optimize targeting, creative, and spend in real time. Email automation with predictive send time optimization. Systems that learn when each individual recipient is most likely to open and engage, then deliver accordingly. Social media management with AI-generated content calendars. Tools that analyze performance data, identify trending topics, and generate optimized posting schedules and content. Layer 4: Operations. AI-powered customer service with human escalation protocols. Chatbots that handle 80% of inquiries automatically, routing complex issues to human operators. Automated accounting and financial tracking. systems that categorize transactions, generate reports, flag anomalies, and integrate with tax preparation. Contract generation and basic legal document preparation. AI-assisted creation of standard agreements, NDAs, service contracts, with attorney review for complex matters. Total monthly stack cost, $400 to $800. Equivalent traditional labor cost, $25,000 to $40,000. The spread is your arbitrage. The critical skill is not tool proficiency. It is prompt engineering, the ability to translate business objectives into precise instructions that extract maximum value from the AI. This is the new literacy. The people who master this will control the next decade of economic output, not because they work harder, because they work differently. Capital constraints are the primary objection. I do not have $15,000 to start an e-commerce operation. This objection misunderstands the current environment. The zero capital path, service arbitrage. You sell services you cannot personally deliver, then use AI to fulfill them. The client's payment becomes your working capital. You are paid before you incur costs. This is how Marcus started. He sold the service first, then figured out how to deliver it using AI. The $2,400 was for survival during the first month, not for business investment. The minimal capital path, content leverage. You build an audience through AI-assisted content creation, then monetize through affiliate relationships, sponsorships, or digital products. The only capital required is time, and the AI compresses the time required by a factor of 10. David started with $800, mostly for advertising to get initial traction. The content itself cost nothing but time. The accelerated path, strategic partnerships. You identify operators with capital but without AI fluency. You provide the operational architecture. They provide the capital. The equity split favors the operator because the operator possesses the scarce resource. This is how Alina could have scaled faster, though she chose to maintain full ownership. In all cases, the traditional requirement, have money to make money, has been disrupted. The new requirement is operational intelligence, the ability to see patterns, assemble systems, and execute with precision. If you have capital, you can move faster. You can acquire customers through paid channels immediately. You can build inventory. You can hire help. But capital without operational intelligence is wasted. It will be spent on the old model, the expensive way, the path that leads to compression and competition. If you do not have capital, you must move smarter. You must validate before you spend. You must use the AI to substitute for capital, doing yourself what would previously have required investment. This takes longer, but it also builds deeper competence. You understand the system because you built it yourself. Either path works. The common requirement is understanding the arbitrage and executing within the window. I am not selling you certainty. I am describing an opportunity with specific, manageable risks. Platform risk. The tools you rely on can change pricing, capabilities, or terms of service. OpenAI can raise prices. Midjourney can restrict commercial use. Platforms can ban AI-generated content. Mitigation. Build on multiple platforms. Never become dependent on a single provider. Maintain the ability to migrate quickly. Document your processes in platform-agnostic terms. Regulatory risk. As mentioned, the current environment is permissive. This will change. Professional associations will lobby for protection. Liability for AI-generated output will be established. Tax treatment of AI-assisted businesses will evolve. Mitigation. Maintain clean operational records. Avoid sectors with existing heavy regulation that is actively enforced. Be prepared to adapt when frameworks emerge. Do not build on legal gray areas that are likely to be clarified against you. Competition risk. The arbitrage window attracts participants. As more operators enter, margins compress. The synthetic agency model that Marcus pioneered in 2022 is now common. Prices have fallen. Quality differentiation has become more important. Mitigation, speed of execution, first mover advantages in niche selection, continuous operational refinement. The arbitrage is not static, it moves. You must move with it. Technical risk, AI capabilities are evolving rapidly. Today's optimal stack is obsolete in 18 months. New models surpass old ones. Integration patterns change. Mitigation, continuous learning, community participation, information advantage through specialized sources. The operator who stops learning becomes obsolete quickly. These risks are real. They are also manageable. The alternative, traditional employment, traditional investment, traditional wealth accumulation, carries risks that are neither manageable nor temporary. Job loss to AI, wage stagnation, asset inflation that outpaces savings. These risks are systemic and individual mitigation is limited. The AI arbitrage carries individual risk that can be managed through intelligence and adaptation. This is the fundamental trade-off. You accept operational complexity in exchange for escaping systemic vulnerability. Information without action is entertainment. Here is a specific, actionable protocol for the next 90 days. Days 1 to 30, Foundation. Select your vertical, not based on passion, based on market validation. Where is money already being spent? Where is friction high? Where are incumbents slow? Where can AI substitute for expensive human labor? Master one AI tool completely, not surface familiarity, deep operational competence, the ability to extract 90% of its capability. If you choose content, master Claude. If you choose visual, master Midjourney. If you choose code, master Cursor. Depth before breadth. Build your first synthetic asset. A piece of content, a prototype service, a validated concept, something that demonstrates the model works, something you can show to a potential customer and say, I made this, I can make more. Days 31 to 60, Validation. Acquire your first paying customer, not a friend, not family. A stranger who values what you have built enough to pay. This is the only validation that matters. Everything else is hypothesis. Document everything. Processes, prompts, failures, successes. This documentation becomes your operational manual and your eventual training material. The businesses that scale are built on systems, not memory. Iterate based on feedback. The AI allows rapid pivoting. You can change direction in hours, not months. Use this advantage. If the market responds to one approach, double down. If it ignores another, kill it quickly. Days 61 to 90, Scale. Systematize what works. Remove yourself from execution wherever possible. Build the machine that builds the machine. Reinvest revenue into tool upgrades, contractor relationships, and audience building. Do not extract profits yet. Compress the timeline. Capture the window. Establish your position before the arbitrage narrows. The operators who build in this window will be the incumbents of the next phase. The operators who wait will be competing against them with inferior positioning. This is not a business plan. This is an operational manual. The difference is execution velocity. Plans are theoretical. Manuals are executable. Build the manual. Final observation. The people who succeed in this environment share specific psychological traits, not intelligence, not education, not connections. These are learnable, cultivable orientations. Pattern recognition, the ability to see structure in chaos, to identify which changes matter and which are noise. Most people see AI as a single phenomenon, exciting, scary, confusing. Operators see specific capabilities, specific substitutions, specific arbitrage opportunities. They distinguish between interesting technology and profitable application. Operational patience, the willingness to do boring, repetitive work to build systems that eventually eliminate boring, repetitive work. The glamour is in the result. The work is in the process. Marcus spent his first month learning tools that seemed magical but required hours of trial and error. Elena spent 3 months building her prediction system before it generated profit. David wrote hundreds of practice questions before he sold his first guide. Emotional detachment, the capacity to kill projects that are not working regardless of sunk costs, the ability to separate identity from any single venture. Many operators fail because they fall in love with their first idea. They persist through evidence of market rejection. The successful operator treats each project as experiment. Validated, scale. Invalidated, kill. Move on. Information hunger, continuous aggressive learning, not passive consumption, active experimentation and synthesis. The AI landscape changes weekly. New models, new capabilities, new limitations. The operator who learns continuously maintains advantage. The operator who stops learning becomes obsolete. If you do not possess these traits, this path is not for you. The arbitrage window will close and you will have consumed content without creating value. There is no shame in this. Different paths suit different temperaments, but there is no wealth in it either. This path requires specific psychology. Assess yourself honestly. Let me restate the core proposition, because everything depends on understanding it completely. Wealth in the modern economy is not created through labor. It is created through leverage. Previously, leverage required capital, connections, or institutional permission. The AI arbitrage has democratized leverage. The only remaining requirement is operational intelligence. The window is open. It will not remain open. The same forces that created this opportunity, adoption curves, regulatory adaptation, competitive saturation, will eventually close it. The question is not whether this transformation is happening. It is happening. The question is whether you will position yourself to benefit from it. Marcus Chen, the former truck driver, recognized the pattern in 2019. He is not unique. He was simply early, and he acted with precision. The pattern is visible now to anyone who chooses to look. The wealth blueprint exists to illuminate these patterns, not to motivate, not to entertain, to provide actionable intelligence for people who are serious about building wealth in an environment that has made traditional paths obsolete. The next script will examine the specific regulatory changes coming to the AI space and how to position your operations to survive and thrive in the post-arbitrage environment. The window is closing, but the next window is already opening. Subscribe, study, execute. This is the Wealth Blueprint.